So you're exactly right. The price increases in the reinsurance market have been important for us. We've been able to achieve an 18% year-to-date increase in prices, and we would expect that to continue at a similar levels or potentially even more. Important renewals in the rest of the year include June and July that are focused largely on the United States. In those markets, you've seen in 2022 very large losses related to hurricanes but other weather events, and we would expect the prices will reflect the reality of both the inflationary impacts on final loss costs for the insurance industry, but also some model changes we've made on these catastrophes, specific perils like the kinds of hurricanes that we've seen in recent years in the North American market.
I want to ask you about investment return. Obviously, a positive investment return here, but as we watch the banking sector grapple over portfolios stuffed with bonds that they're going to have to hold to maturity now because of the way we've seen interest rate changes introduced by the central banks, I think we're all trying to understand what a portfolio mix right now should be and what businesses like yours do with legacy bond positions.
So for the insurance industry, it's probably less of an issue than for the banking industry. We appropriately match our assets and liabilities very closely. The regulatory capital regimes encourage that behavior, but our economic views of our own positions enforce it as well. And in that context, what we see is our ability to reinvest maturing bonds with a duration on average of somewhere around 5 or 6 years into the current investment environment, and that's been positive for us. We've seen that recurring interest yield continue to move up quarter after quarter for the last 5 quarters. It's now at 3.1%. We would expect that to continue to increase, and that's very good for our underlying economics.
We're always looking at P&C, of course, but Corporate Solutions knocked the ball out of the park on the combined ratio, down as low as 90.3. What can you do to build upon that?
So there are different parts of Corporate Solutions businesses. Some are performing extraordinarily well. Some we continue to look for continued price increases, largely around the casualty lines of businesses. Overall, we're pleased with a 90.3 combined ratio, and we're interested in growing this book as we see the opportunities during the rest of the year. The underlying growth for the business in the first quarter was about 7%. We think we can continue to do that with the attractive pricing that we see in many parts of the market.
Christian's talking about the outlook and saying in an uncertain macro environment, you're still focusing on some pretty ambitious profit targets. What is the biggest risk for 2023, John?
So the nature of our business is we manage the tail risk on liabilities, large catastrophes. We absorbed some substantial catastrophes in the first quarter, about $600 million in our reinsurance business dominated by the earthquake in Turkey. We cannot predict where these catastrophes might land and the dimensions. We think we've got them priced appropriately as we go forward. So there's clearly one risk if there's some truly extraordinary event in that sense. On the macroeconomic side, we maintain an important fixed income portfolio that includes corporate bonds. We've been able to stay on the very high end of credit quality. We've had no impairments in the first quarter of this year. We don't expect that we'll necessarily have to have impairments, but obviously if the major markets were to go into recessions, the reinvestment rates were to come down dramatically, that would put pressure on our ability to achieve these results. But for now, what we see both in the pricing of the reinsurance market and the macroeconomic situation, which has calmed a bit, the interest rates, even if the 10-year is down now to 3.4, we think that there's still opportunity for us to continue to improve the returns on our investment portfolio.